Ladies and gentlemen, good day and welcome to the Q2 FY26 earnings conference call of Birla Corporation, hosted by HDFC Securities Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the call, please signal an operator by pressing star, then zero on your touch-tone phone. I now hand the conference over to Mr. Rajesh Kumar Ravi from HDFC Securities. Thank you, and over to you, sir.
Hi, good afternoon, everyone. On behalf of HDFC Securities, we welcome all of you to the Q2 and H1 FY26 earnings call of Birla Corporation Limited. From the management side, we have Mr. Sandeep Ghosh, MD and CEO, Mr. Aditya Sarogi, Group CFO, and other senior members of the team. I now hand over the call to the management for the opening remarks, after which the moderator will open the floor for Q&A. Over to you, Sandeep, sir.
Very good afternoon, everybody, and thank you for joining our Q2 call. This happens to be, I think, our three running years, or shall we say, 12 consecutive quarters of calls since we started doing it in January 23, and we have been encouraged by the level of response and interest which we have found from the analyst and investor community. That gives us, as management, a lot of confidence in the strategy which we are following, and the appreciation of the communication which is happening. It's a two-way situation, gives us a lot of feedback, but I think it probably reinforces our conviction as well as the confidence which we receive from talking to all of you. So thank you once more. This quarter, as we know, we have been, I think, fairly consistent with the industry per se, though our scale is much smaller than some of the very large players. But despite that, I think we have stayed in line with the broad industry performance. And this is despite a few headwinds. We, as you know, operate primarily in the central region. And as some other companies have also stated in their communication, the prices in central region has remained the most subdued compared to other regions throughout this period, and even subsequently as we move into the third quarter. That has been one headwind. Obviously, the heavy unseasonal rains in our key markets have been also a dampener. On our side, we had a setback at the end of last quarter itself in terms of a breakdown in our one of the biggest units, that's Maihar, and we had an overhang of that into this quarter, for which we had to continue using the purchased clinker from what we had bought from outside, and so that carried on, and that gave us a dent in our profitability. And had it not been for that, we probably would have reported much better results than what we have, though it seems from all the comments we have seen so far, the market and analysts have been generally positive about what we have reported, but we could have done slightly better than that too, had we not had this particular setback. Mukutban, also that area was affected by heavy rains that was during the period, and which caused dislocations and dispatches. So our Mukutban, the volumes were probably lower than what we had been budgeting for, but that is a temporary aberration as markets open up, and we feel we should get back on track as per our original projections. So that's broadly an observation. You know all the trends. Now, September, as we all know, the GST was a major disruptor, the GST changes. How it affected us, especially in the central region, apart from generally, and it's probably useful to point out, the biggest hit came in the non-trade sector, industrial sector. Mercifully or thankfully or really speaking as per our plan, our exposure in the non-trade is very limited. We don't even sell about more than 15% of our volumes in the non-trade sector, so our exposure is very limited. But overall, that is where the biggest, slide in prices happened. And obviously that also has its fallout and spillover into the trade segment as well, affecting both demand as well as prices. But the biggest, as I said, the slide happened in the non-trade sector for two reasons. Many companies, a lot of companies there in our region, some of our peers have the benefit of incentives, GST incentives they have because of their new facilities, and many of them took advantage of dispatching, making higher dispatches before the changeover of rates, because even taking into account subsequent drop in prices, what they stood to gain in terms of incentives was pretty significant. So as a result, there was a huge buildup of stocks in the non-trade pipeline, as well as therefore post the changes, there was a very sharp drop in prices, sharper. So therefore, actually, it became a double whammy. There were price slide in anticipation of the GST changes. There was a slide in the market. But because of the factors I mentioned, there was an even bigger slide post the 22nd of September, and which actually has carried on to October. That's a different story. But I'm underscoring that we were able to insulate ourselves to a large extent from this impact because of our consistent stated strategy to focus on the trade segment, that is the B2C segment, and also focus on blended cement. And third point is on premium product. So some of you have expressed surprise at the realization and profitability, but that's been the key driver of our profitability despite some of these, headwinds, as I mentioned, or negative trends in the market. Here, the strategy has been vindicated, and this has been vindicated at large because, as I've been repeating, though we had moved out of the incentive period in UP last year itself, the new entrants who came in with newer plans and incentive, they have focused primarily on non-trade and OPC, and having been unable to penetrate much into the trade segment, the value-added segment, and the value-added trade segment, the premium segment. So therefore, their impact has remained a great deal in this OPC and non-trade segment over there. And we have managed to keep our head above the water despite any, sort of ups and downs and turmoil in the market. So that has been the story overall. Last quarter, though we have a very small presence in Eastern India, our Durgapur plant has done, despite that, well. Rajasthan, we have managed to regain our volumes in the trade segment. That has been, a very positive development over there. We had in the previous year, again, led largely by the low prices, which made our products unviable in some certain markets. We had lost market share in the previous year. in the overall context and volumes, we have been able to recover much of that. Maharashtra, we remain as per strategy, barring these few aberrations we talked of, but we are led, really speaking, by what's happening in the market and the overall prices or demand situation. That's what affects, but we are otherwise we are not operating with any lag or handicap vis-a-vis either the old established player or any other newer entrants. So that's my overall summary. I will hand over to Mr. Sarogi, our CFO, and my colleagues, Rajat Prushti, who is the CMOP, and Mr. Kalidas Pramanik, who is our sales and marketing head, to answer any other questions. So, Aditya, would you like to go in, or we'll open the... So, in the interest of time, we would open this out for now the questions, and we can take it, the question answer and any additional comments simultaneously.
Sure, thank you very much. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Also, before we begin, a request to participants to please limit your questions to 2 per participant. Should you have follow-up questions, we request you to rejoin the queue. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from Shravan Shah from Dolat Capital. Please go ahead.
Hi. Thank you, sir. Sir, continuing to your opening remarks, so 2-3 points just wanted to put together. So the clinker purchase in the second quarter and your opening commentary, you are saying the prices are under pressure till now. So if you can help us in terms of quantify. So currently the prices till now versus the 2Q average for us would be how much lower, and also possible region-wise, if you can break it up, would be a better. And given that the prices are under pressure, how do we see now the profitability, which is around 700 plus for us in the first half, and what kind of a cost saving we have? So in the second half, how one can look at the profitability inching up?
You have combined many questions into one, Shravan, and so we'll have to sort of unbundle them and talk to you. So first of all, we said about what you asked about the clinker purchase. It has...
we can't give specific number.
We can't share the specific numbers there, but I think you can make a rough guess. It would have, it's not very large, but it would have...
25 crores. 20-25 crores.
Yeah, kind of number is what we have had in the for that setback. But that's all, water under the bridge now behind us. We are now very, very comfortable on clinker stocks, and our plants are operating full steam. So we have no such contingency to worry about throughout. The rest of it, I think all of you have been tracking prices. So we have been in line with the price scenario. As we said in our net realization, or in terms of the bottom line, we have tried to improve by having higher component of our value-added product, the premium product, etc., which the numbers we have already shared in our press release.
As regards H2, normally H2 is better than H1 because in H1 we have got this lean season of monsoon period. So definitely in this year also we don't expect any exception. We expect the second half to be better than the first half of the year.
So the demand scenario is, again, we are not saying anything more than what the market has said. Prices, as we see, it depends. We are already getting into the close to the second half of November, but we think there should be some price improvement beginning to happen from the second half. But really, if the demand picks up, we'll see the major correction coming in the last quarter.
Okay. Okay. Got it. Because just wanted more clarity in terms of the number. Till now, if the prices don't improve, will it on an average basis, though the premium sir is helping us in a decent way, but on a ballpark basis, kind of one can assume kind of 100 odd rupees kind of a impact if the prices don't improve from here on for the third quarter. That's the way one can broadly look at.
We won't commit on numbers, Shravan. You've been with us for a long time, and prices, really speaking, as we said, I think it will have to be led by the non-trade segment, and without that recovering, and that we are not really major players, so we are looking up to what the market does, and then accordingly we think sympathetically one will change. Nobody is going to take prices aggressively up now than what the market naturally can take it.
Got it. Lastly, ask a couple of data points. Lead distance for this quarter, Kcal cost, and the capex for full year would be how much?
Lead distance for this quarter is 340 kilometers. Kcal cost is 1.48, and the third one, the capex for the entire year, we expect to be around 800 crores.
Okay, so it is lower versus what we were looking at, 1,000 to 1,100 odd crore.
Marginally.
Right.
Yeah, got it, sir. I have a question. We'll come back in queue. Thank you and all the best.
Thank you. The next question is from Manish Chaudhary from Phillip Capital India. Please go ahead. Mr. Manish Chaudhary, you may go ahead with the question. Mr. Manish Chaudhary from Phillip Capital.
Hello, am I audible?
Yes, please go ahead.
Actually, I have not pressed anything to come into the queue. I think there's a mistake.
Okay, sure. We'll move to the next question.
Nice hearing your voice, please.
We move to the next question. The next question is from Saket Kapoor from Kapoor Company. Please go ahead.
Yeah. Namaskar, sir, and thank you for this opportunity. Sir, firstly, my question is to Saraogi ji, sir. In the cash flow, we have mentioned about direct taxes paid to the tune of 91 crore. So this is the net cash outflow on account of this advance tax payment as on September, or any other component is also embedded here?
There is no other component. It is the routine payment of taxes.
Okay, that translates into 45% of what the total tax liability for the year. That is how it is worked out?
I can't comment on that, Mr. Kapoor.
Okay, sir. Sir, for the EBITDA per ton for this quarter, I think so we were in the range of 712, and for the first half it was at 714. So taking into account the current environment and the opening commentary by Sandeep sir, what should be penciling in terms of the EBITDA trajectory going ahead?
We also commented on that, Saket, that we don't predict.
We expect second half to be better than the first half, but beyond that we can't discuss specific. No other cement company also does, so we also
cannot. There are variables in the market just now, which all of us are aware of. So we don't want to give you any indication of commitment which doesn't have a strong basis.
Right, sir. Sir, on the efficiency front, if you could just outline to us the backward integration in terms of the captive coal output that we are anticipating from the two mines for this year. How is that? How is the ramp up going ahead?
Rajat here. Yes, already the Sialgaburi is going on, and for the Bikram, already the activities are on. We expect that during the end of this financial year, we'll start some activity and maybe you can touch the coal production also.
So meaningfully, from next financial year only we'll start getting the production from Bikram coal plant.
Okay. Sir, in your commentary, just to conclude, you have mentioned about the management expect, I quote, cement demand to revise in the 3 months ending the December, led by government capex, translating into a YOY volume growth of 4 to 5%. So this is what we can work out our number in terms of what you are anticipating. So we are on track, even after taking into account how October has been. When we have factored in the month of October with this comment.
Yes. Saket, we made a declaration on Friday, so obviously we have taken that into account. There should not be any change. It's as recent as that.
Right, sir. And sir, just a very small comment. As in your opening remarks, Sandeep sir, you have very well articulated to us that what the communication means for investing community in creating the awareness for the company as a whole. So through the channel, I would also request you to abreast our chairman also about the group companies and the valuation that currently are there for the market to understand, to open up the same medium for other companies also, so that the insights and awareness can be created through this platform, so that the benefits flow to the other group companies also. My humble submission, if that could be forwarded.
We are that way independent companies and independent board of directors and things. And I'm aware you go and attend the AGMs of all other companies as well. So I'm sure you have a forum and opportunity to voice your, expectations.
Correct, sir. I'll join the queue for a jute question. Yeah, if time permit, may I ask that or shall I revert?
Go ahead. You will.
Yes, sir. Thank you.
Permitting, not permitting, you will ask. I thought you also had pressed the button by mistake, but I will take it.
Sir, you are always ready with your one-liner, sir. Congratulations on that. Sir, for the jute part of the story, sir, if you could just allude to us, what is the thought process of the management currently with the type of scaling up of this segment, since it's a legacy and we were earlier known as Birla Jute. So taking into account the capex done by other people, I think so an announcement came from the Kanodia Group also today in the business daily of upping their capacity by a meaningful 30-40%. So what are we outlined for jute as a sector in terms of volume, capacity growth and profitability also, because the margins are very meager when we look at what we have posted.
Saket, first of all, we still remain Birla Jute and we are very proud of our heritage. Because as I keep repeating, we are the oldest Indian jute manufacturers and we remain probably the only major company which the ownership has not changed hands right from the inception. Whereas many of the foreign companies which were there, the foreign owners have left the place and thereafter also it has changed several hands. Many of them, there are very few who remain consistent. So we have an abiding, commitment to this business. It's close to our heart, and we, just like in our other business, also we have done things which is right for the business. That's what we will try to do. But the change which has happened is now jute has been mainstreamed in the company. It is no longer like a satellite unit which is operating separately. Our top leadership team is fully engaged in the jute operation. We took a step, since you know this, which is very unconventional in industry. For the first time, we have a head of the business who has moved from the main business to jute. Rather than being people usually take career jute people from either here or there. We have taken our person. The intent behind it is to bring the same synergies and the efficiencies and discipline which we have in our main business, focus not only on improving technical efficiencies, but also start focusing on R&D. And so our first intention is to grow through value addition. By value addition, I don't mean just value-added product, but creating more value and profitability. There's a lot we believe can be done in jute. So we are not really concerned about just adding a few machines and hands and, opportunistically and increasing the, looms which are there and thereby get additional quota and do that. We want to do what is right long term for the business. We are already, as you see, we are seeing we are beginning to see results, and just like in cement, we have stuck consistent with the strategy. We hope that we'll be able to move forward in the same way in jute as well. But it's a bit early in the day. Just like in cement, we have taken 2-3 years to build your confidence. We hope that in a few quarters down the line, you'll see the difference.
Right, sir. Thank you. I'm joining the queue, sir. Thank you.
Again?
Yes, sir. Thank you.
Thank you. Next question is from Anup Lal from Eureka Stock and Shares Broking Services. Please go ahead.
Thanks for giving me the opportunity. Basically, likely to know that currently your premium brand contribution is around 60% of trade sales. So what is the target mix for FY26 or?
So,
hello?
Hi, sorry.
Yeah.
We will remain in the same region, Anu. We don't want to vacate the territory. We have a strong presence on both segments. Our brands are equally strong. Our Samrat and Chetak is very strong in the value segment, whereas Perfect Plus has been making rapid strides in consolidating on the premium segment. We don't have right now too much of headroom in capacity. So this is how we are going to operate. We are committed to both the segments, and that fits us strategically. We consider it to be a strategic advantage because compared to whether our bigger peers, larger peers, or people who are at the same level or smaller, we have the only company who almost straddles between the two segments almost equally. So unlike, as I said, some of the bigger peers are present primarily only on the top segment, the A and premium category, whereas people who are on the other side, they are trying to inch up some of their thing to get up a level of premium mix in their volume, but their premium is actually far lower than at the level where we are operating in the A category. So they are doing that, whereas we have presence on both sides, and we also have a presence now in what I would call the upper value segment, because we have, when we are looking at Samrat, we have a product called Samrat Advance, which is actually at a level compared to what others are calling premium from the B category. When we are Samrat Advance is at par with them, whereas Perfect Plus is clearly, as some of you have commented in your assessment, we are clearly in line with the top A category players. So we would like to operate that way. We consider it to be, as I said, a competitive advantage, and this is how we wish to stay there. We are not going to abdicate or abandon one segment for the sake of others. We see merit long term in being present in both, and that's how we are going to. And because we see not only merit in both, we feel there is a market in both ends, whether you look at segmented geographically or segmented market-wise. So that's part of our strategy. And so far we have done well, we believe, and we'll continue on that.
So my next question is regarding the increase of share of renewable energy to 32% in the second half. So what could you quantify the cost savings?
We can't quantify the cost saving as such, but definitely it should be in line with the industry.
Okay. So thank you. Thanks.
So when we talk, only thing is what I'll say, our renewable energy is essentially a mix of solar. We are getting into hybrid and all of that, and that is our higher level. We are not so high on alternate fuel, etc. So you'll find it in these two categories, and there the benefit, as Mr. Sarogi said, is in line with what other industries are getting, and also varying from state to state. So it's fairly easy to, I think, extrapolate.
Okay. Thank you.
Thank you. The next question is from Uttam Kumar Srimal from Axis Securities. Please go ahead.
For the opportunity and congratulations on a good set of numbers. Sir, my question pertains to your capacity expansion plan. So can you give a timeline for a Kundanganj unit? Hello?
Sorry.
We are expecting Kundanganj to commence by the end of third quarter, beginning of fourth quarter.
Okay. And sir, on RMC business, you can give some timeline, how RMC business is going on currently and how much plant we are planning to open in RMC business?
RMC business, as we said, we are still on a, we are progressing steadily and slowly. We are in no rush to expand and then burn our, hands and feet and all that, which many people have done. The profitability component there is lower. So we are taking wherever there is a clear synergy with our brands, we are trying to see, and we would like to progress in a very not only steady but sure-footed way. We are in no great anxiety to expand the volume and again share. Again, a lot of people are doing that because they have a lot of spare cement and they are doing it as a captive source. We don't have that as an any compulsion. Our own cement we are selling well. This we are trying to do only to expand our footprint. We see a lot of synergy in our brand because we are operating RMC under the Perfect Plus umbrella. So far the markets where we have entered have got clear, presence of that. We are present in Lucknow, which is a strong market for us in Perfect Plus. We have moved up to Ayodhya area, which is again a strong market because we want to get benefit of our branding. Your RMC, as you know, is at the base level. If you're looking at the vanilla RMC, it is a very, very low cost, low margin kind of an operation. People don't make much money. And you start making money only if you're providing value-added RMC, which is the high tech, or if there is a brand value people are willing to pay for your product. You really can't compete with the small players and everybody just giving them vanilla products. So that is the route we are taking, and therefore we want to move forward systematically, making a combination of the market opportunity plus our brand synergy there. So if there is an area where our brand is not present, just for the sake of opening a unit, we will not go. We know some players who have got plants all over the country where they don't have any brand presence or even manufacturing presence. We are not going that route. We are going clearly expanding where we are strong.
Okay. And sir, Sarawiji, last one, what is current net debt?
About 2,450 crores.
Okay, sir, that's all from my side and all the best.
Thank you.
Thank you. The next question is from Rajesh Kumar Ravi from HDFC Securities. Please go ahead.
Hi, sir. Good afternoon. My first question pertains to if you could share what was the incentive accrued in Q2, and also how was the ramp-up happening in Mukudvan? Like you shared the Q1 volumes, what was that in Q2?
The incentive in Q2 was about 18 crores.
Okay.
And second
Yeah, Mukudvan volumes.
But then volume was 6 lakh tons in this quarter. So there is a Y-on-Y growth of 20%.
20% rate. And sir, this GST, will this change, how will this change post the GST rate cut from 28 to 18% quarterly accumulation?
For of incentive.
Yeah, incentive accrual which you will be making.
Largely, we are not expecting any major change. In some states like Rajasthan and all, it might come down. But that is just about maybe 10 odd crores.
Rajesh, there are two components to this, as you know. Some places there is a GST cap in terms of the absolute. So if in the earlier scenario we were exceeding the cap, what we could draw during the year, now the rates have fallen, so that's still the cap remains. So if in absolute terms we can claim that GST, we claim that. So therefore there is no actual loss on that. Secondly, you might say it's a blessing in disguise or otherwise, since we didn't have incentive in Uttar Pradesh since last year. Now our clock will start ticking in the new with the new rates from day one, so we will plan it accordingly. So whatever we will get now from Kundanganj line 3, it will be incremental from what we have at the moment. So as Mr. Sarogi has said, we are not anticipating any major thing. Only place we are getting affected a little bit is Rajasthan because it's all linked to how much sales in Rajasthan and within that.
Incremental sale.
Incremental sales. Therefore, so Rajasthan, but there our stakes are not very high.
Understood. And sir, on the expansions plan, you have lowered the capex outgo guidance from 1,200 odd crore to 800 crore. So could you just share what is your third plan or what is your...
This is the sustainable capex, sustaining capex. This is not really our expansion.
If you look at the historical trend, also we at the beginning of the year, the guidance we usually we end up spending lower than that.
Okay. I just wanted to understand this Maihar expansion. What is the progress on that, and by when? How much capacity? What stage of the expansion we are in the central region beyond the Kundanganj?
Rajesh, on that we are maintaining our earlier guidance. You can check our earlier guidance. We are maintaining that guidance in terms of capacity expansion.
Okay. So next year, how much capex you're looking at? FY27?
We can't at this stage give you year-wise capex. Maybe down the line we can share that.
Sure, sir. ठीक है sir. I'll check on that separately. Thank you.
Thank you. The next question is from Vipul Kumar Anupchand Shah from Sumangal Investments. Please go ahead.
Thanks for the opportunity. Most of my questions have been answered. I just have a question on some of our plants are efficiency-wise operating quite moderately. So is there any plan to upgrade them? And what will be the capex required? What will be the timeline? Which plants you are considering? If your broad comments will be welcome, sir.
I will let Mr. Prushti answer that, but I don't know where you're talking about. We are operating lower than efficiency, because if you see our capacity utilization, when there is, I think we are operating in all our older plants at peak capacity or higher. Only it is in Mukudban, which is still in the process of reaching the peak capacity. We are below our nameplate capacity, but everywhere else, we pride ourselves in the efficiency what we are doing. Okay.
So, already rightly said by Gosar, we are operating in the efficiency point of thermal, electrical, everywhere we are working, and already they are very good numbers, and they are benchmark numbers in many of our plants, both in terms of grinding and thermal, electrical power for the clinkering also. And capacity point of view, you have seen the results also. It's already we are more than 90% we are operating, and the availability, reliability is really good. So we are continuously focusing there. Yes, one plant we have a little bit of higher thermal because of the old technology, but there also we are operating to establish that what is the best possible way. And if there is in a future requirement will be there capex, we'll review that, because now at this point of time we are operating all the kilns and all the mills at the peak rate capacity with efficiency.
Thank you.
Thank you. I think we should close here, Rajesh. Shravan and Saket get, disproportionate time, and people will almost suspect that we plan them to ask more questions. So we should close it here. Unless
Sure.
it's very pressing to ask.
Sure, we'll take that as the last question. I would now like to hand the conference back to the management team for any closing comments.
No, we are all, we're looking with, cautiously at this quarter. I think that will, this third quarter will show the light for the fourth quarter. So like everybody else, we are, looking at it circumspectly, still keeping our confidence with the kind of growth which we have indicated and a reasonable improvement in realization, especially coming in the fourth quarter. Thank you very much.
Thank you very much. With that, we conclude today's conference. Thank you for joining us, ladies and gentlemen. You may now disconnect your lines.